Before we talk about the barriers to credit, let's start by asking whether access to credit is even important to farmers. Well, without hesitation, the answer should be yes. All agricultural enterprises, particularly farmers, can benefit from credit, and here's why. Credit allows farmers to operate their business and invest in the costs of production, including seeds, labor, fertilizers, crop protection products, fuel, vaccinations or medicines for livestock, etc., before they receive payment for the sale of their product. So what are the reasons why formal credit is often scarce for farmers? Well, let's focus on four main reasons here. 1, the cost of capital. 2, a borrower's bankability. 3, a lender's willingness and capacity to lend. And 4, the legal and regulatory framework for financial markets. Now we will discuss each of these factors in turn. The cost of capital, or the cost of taking a loan, is often prohibitively high for small farmers. But what causes the cost of capital to rise or fall? Basically, the cost of capital reflects expected inflation, the operating costs, and the perceived risks of lending. If inflation is high, the real value of money today will be worth less tomorrow. In this case, lenders must charge higher rates of interest to recoup their investment. And if lenders are not certain that a borrower will pay them back, then they may need to charge higher rates of interest to cover this perceived risk of default. So while interest rates on loans to small farmers may seem high, they often accurately reflect the costs and risks faced by the lender. Next, a borrower's ability to meet the requirements and standards for loan applications will influence their ability to obtain credit. Specifically, formal lenders often would like to see 1, a farmer's borrowing history. If there are records of previous loan repayments, then this reduces the perceived risk of default for the lender. 2, a farmer's expected cash flow from operations to show how the loan will be used and what the expected returns will be. And 3, a farmer's collateral, which can be seized in the event of a default to reduce the risks to the lender. Collateral may be considered in the form of savings in the bank, physical real property such as land, movable property such as livestock, or intangible property such as an expected future harvest. Loans that use collateral are called secured loans, while those without collateral are called unsecured loans. The agriculture sector presents several unique challenges for lenders. First, where formal lenders have little experience lending to the agricultural sector, then they will be unfamiliar with the cost of production, harvest schedules, and expected returns for varied agricultural products. Second, agriculture is subject to what is known as covariant risk. This means that when extreme events occur, such as a drought or flood, then large numbers of producers in a geographic area are affected. Third, in developing countries, non-existent or weak credit bureaus means lenders have limited knowledge of farmer creditworthiness. Fourth, it is operationally challenging and expensive for lenders to disperse and monitor a portfolio of small-scale loans across a geographically remote area. And finally, where governments interfere in financial markets through poorly run, politically motivated, state-owned agricultural banks, then the private financial sector has a strong disincentive to expand lending. There are also several legal and regulatory aspects that expand or restrict credit to farmers. First, crafting and enforcing a secured transactions law is necessary for lenders to seek recourse in the event of a default on a secured loan. Seizure of collateral from small family-run farms has potential social implications. However, a well-designed secured transactions law also creates a strong incentive for borrowers to repay, thereby expanding credit to more farmers. Second, laws on land title will determine, for instance, if traditional customary land rights can be used as collateral for loans. Third, the presence of a movable collateral registry will enable expanded lending to those farmers with limited real property. Fourth, contract laws are essential to expand supplier credit, as the expected future harvest serves as intangible property collateral for credit. And finally, laws enabling semi-formal lenders such as NGOs and MFIs will expand credit access for farmers.